Tax Fact Friday. We're going to talk about tax rates. I promise we're going to do it quickly. My first shot at this video was 12 minutes long. We can do a lot better. Here's the point. Tax rates are complicated. You need good tax and business advice. You're not going to get it from the news. They are oversimplifying things in terms of how taxes are paid, how tax rates work, who pays taxes and who doesn't. You need to talk to an advisor about how all of these things may apply to you. To give you a little bit of a sense of that and to lay a foundation for conversations that we need to continue having about what might happen in the future, let's talk about the current landscape of income taxes at a very high level. We're going to leave a lot out here because we have to, because we need to do this quickly. Corporate income tax rates. The current rate for a corporation at the federal level paying its own taxes is 21%. There's been talk of that going up to 28%. I talked a couple of weeks ago about some possible alternatives to that that don't necessarily make sense. I won't go into that, but right now, the federal corporate income tax rate is 21%. Okay, if you are working for somebody else, or if you are operating your own business as some other type entity, a sole proprietorship, a partnership, a small business corporation, an S corporation, that does not apply to you in that business. So put that to the side for a minute. Let's talk about what does apply to you, apply to me, apply to every other taxpayer in the U.S. It's the individual income rate structure. The top rate right now is 37%. We're not going to talk about alternative minimum tax. A couple other things we're not going to talk about in detail. I'll mention a couple of them. The top individual rate right now is 37%. The lowest rate at the moment is 10%. We're going to focus on the 37% just to keep the math somewhat simple as we do a little bit of math. Now, again, there is talk of that top rate going back up to 39.6, where it was before the Tax Cuts and Jobs Act passed at the end of 17, went into effect at the beginning of 18. Hasn't happened yet. That's just one of the things that may be on the table. Now, something else to remember is if you are running a business and your income qualifies and you meet some other criteria and go through some complicated math, that's a whole other series of conversations, something called the qualified business income deduction may apply to you. And this is, again, if you are receiving qualifying business income, okay? That deduction could, and it's a deduction of up to 20% of that qualifying income. It might be less, you may not qualify at all, but it could be up to 20% of that income. So if we simplify things and assume that you are paying income tax at a 37% rate, and again, not all of your income would be at that rate, but let's just assume that applies to all of your income, and all of your income qualifies for a full 20% QBI deduction, well, then you're not paying 37% income tax. You're paying 37% income tax on 80% of that income. Again, I'm ignoring here the lower income tax brackets that would apply to keep the math simple. So 80% of 37%, basically taking a 20% deduction on that income, would get you an effective rate of 29.6%. Income tax rate. It's neither here nor there. I'm not saying it's good. I'm not saying it's bad. I'm saying it's there. There's also talk of that QBI deduction being rolled back or being taken back at certain income levels. Has it happened yet? It hasn't. Again, there are already certain rules in terms of phase outs and qualification. I'm not going to get into those, but there's discussion of potentially raising taxes on some people at certain income levels by putting some more restrictions on the QBI deduction. But that's how that works right now in a very, very oversimplified nutshell. Now, something else to keep in mind, capital gains tax rates, more on this later, but currently long-term capital gains rates, qualifying capital gains, qualifying dividends, tops out at 20%. That rate actually is as low as 0%, depending on the taxpayer's income. We're going to focus on the 20 right now. Again, there's talk of that potentially going away or changing for certain taxpayers. Not going to touch that. That's a conversation for another video. Now, let's talk about the QBI again, or actually let's talk about net investment income tax. That was in the news this week. That is the tax that we were given several years back with the passage of Obamacare. There have been lots of fights over that, whether it's constitutional, whether it's appropriate. The Supreme Court actually ruled this week that it stays. There had been some talk about whether it would go away. Would it be retroactive when it went away? Would people get refunds? That's now off the table, at least right now. Supreme Court has ruled it stays. So we've got the 3.8%. So let's look at something interesting. Let's go back to the corporate tax rate for just a minute and sum this up. Again, just to make the point that this is complicated. If you're operating as a corporation, again, that corporation is going to pay income tax on its taxable income. We're not talking about timing of income. We're not talking about timing of deductions. There's a whole universe of things we're not talking about. We're assuming we've got income that's subject to tax at that rate, okay? You're going to pay 21%. If you take the cash out of that corporation as a dividend distribution, we're also not talking about compensation. We're not talking about payroll taxes. If you take it out as a distribution, you're going to pay inside the corporation 21%. The net that you can take out, you will pay, if it's qualifying dividend distribution, at as much as 20%, but the net investment income tax would also apply in that case under current law. So you're really paying 23.8%. You flush that all the way through this system. The net tax on the money that you had made in the corporation and were pushing out could be as high as 39.8% at the federal level. Now, there is some discussion to be had here in comparing that 39.8% if you're operating a small business or even a large business as a corporation versus as a pass-through, in which you could have a situation that looks more like what I talked about over here with the 29.6% effective rate. So you have potentially some comparison here. There are a lot of things there that could make each or both of these move, but there's some interesting entity structuring discussions to have there. Again, the takeaway here is that there are about 20 different planning conversations that I barely touched on here, and I barely scratched the surface. Do not take your tax and business advice from the news. Talk to your advisor. Talk to your CPA about the structure that's right from you, that is right for you. The structure that you need to have for a new business. The timing of income and deductions, proper reporting. These are things you need to talk to an advisor about. Don't get your advice from the news or the internet. So that's it for Tax Fact Friday. We're going to talk a lot more about tax rates and what may be changing in the future. Thanks.